You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now, here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started first with Strategy Spotlight.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Randy Frederick of Schwab. Randy, thanks so much for joining us today.
Thanks, Joe. Great to be with you.
Now, before we get started on today's topic, which is the covered combination, how about if you tell our listeners a number of things? How about if we talk a little bit about your career path in the industry, maybe how long you've been at Schwab, the team you work with, and abilities at Schwab?
Yeah, sure, I can do that. I've been in the industry for about 26 years altogether, and the majority of that has been spent at Schwab. I've been at Schwab for about 21 years now. What I do primarily at Schwab is I do research, I do education, and I do public relations primarily for both the options business and the active trader business. Really, options are a subset of the active trader business at Schwab.
That's that's a heck of a long run there at Schwab, 21 years. And do you work independent or do you work with a larger team?
Well, I'm part of the research department at Schwab. Everyone in the research department at Schwab has a very specific skill set, a very unique background of expertise in a very certain subject. So we have someone who's an expert in economics, someone who does international research, someone who does sectors, someone who does currency, a couple that do fixed income, one focusing more on government bonds, one more on municipals. My area of expertise, where I've spent the majority of my career, is on options trading, and then over about the last 10 years, also active trading. So that's my area. But I have a pretty small team. I have only one assistant that does some work for me, so that my team's actually quite small, just two of us.
Well, options being your expertise, how about if we roll right into today's Strategy Spotlight segment, and you decided you wanted to talk about the covered combination, which I think is it's an interesting strategy, but I think my guess is a lot of our listeners are not familiar with the covered combo or covered combination. How about if we start by you explaining exactly what that is?
Sure. So option strategies, especially those that have multi-legs, can oftentimes have very interesting names, and I think the covered combo is one of those. But admittedly, it is a bit of a misnomer because With a covered combo, your upside is covered by the stock that you own, but your downside is actually only covered by cash. It's not really covered by stock. So, it's just the term that we use. A lot of times the terms are kind of funny. They sometimes depict the picture of a profit and loss chart. This particular one, I'm not sure where it came from. It does make some sense, but I think it's good to clarify that it's not necessarily covered on both sides. It's covered by stock on the upside and cash on the downside.
Well, you talk about those funny terms. Are you referring to like the jelly rolls and the Christmas trees, condors, butterflies, all that jazz?
Exactly. Condors, butterflies, albatrosses, you name it. The cover combos is an interesting strategy. The reason I wanted to talk about it, I like it because it's really a unique way to establish both a buying price on a stock that you like and also a price at which you might be willing to sell some of this stock that you own because it hits a price that you like. Most people are familiar with covered calls. Most people are familiar with a naked put or a cash secured put is actually the way I would describe it, because you can do that in a margin or in a non-margin account. And these are both strategies that are designed to generate income in a sideways market. The covered combo is actually a combination of both of those two put together, which is what I like so much about it.
And you mentioned a couple times, the underlying. Sounds like, the opinion on the underlying is critically important, as it frankly is with really all option positions. Tell me a little bit about how investors can, develop a confidence in their opinion of the underlying, maybe some different tools that are out there, tools that you use.
Sure. So this, again, like a lot of strategies, is a strategy that you only want to utilize on a stock that you like. And, in fact, while some option strategies are designed to be used on a stock that you like, this is one that is not only on a stock you like, but a stock that you already own as well. So imagine, there are a lot of different ways that a person can pick a stock. At Schwab, we have a fundamental research department that creates a Schwab equity rating system that's basically like your letter grades that you're used to as a kid, A, B, C, D, F. And we tend to recommend people buy the A's and B's, and if they get downgraded to a D and an F, then they sell them. Obviously, active traders especially spend a lot of time looking not only at the fundamental factors, which is what that model is based on, but also technical factors. So if you're in the market for a little bit shorter term, you're not necessarily buying a stock that you want to hold forever, then you want to take a look at technical analysis, of course. There are a variety of different things, and our trading platforms, like most others, have a very large number of technical studies that can be added to a stock chart. So it's a combination of both. But I think the key is not so much the strategy you use to pick the stock that you like or what it is that led you into this position to begin with, but the importance being that don't use this strategy unless it's a stock that you're comfortable with, that you like, that you'd be happy to, in many cases, even own more of if you could get it at a fair price, but at the same time would be willing to let some go if you got a nice price for it. So I think that's the key for this one.
And so the covered combination, back to exactly what it is, we're talking about a cash secured put on top of a covered call position.
Yeah, so let me give you just a little more detail. So if you're like most investors, you've probably got some positions in your account. Even if you're a trader, and I always make a strong point when I speak to groups that traders need to also be investors, because you should never be a trader with your entire portfolio. You should carve out a 20 or a 30% chunk of your portfolio that you want to trade a little more actively. But you probably have some positions in your account that you've held for a very long time, but that doesn't mean that you wouldn't be willing to let at least some of them go if it got to a certain point. You could take some profits, right? Unless your goal is strictly to earn dividends, most people buy stocks with the hope that they'll actually go up and they'll have capital appreciation, and they may be willing to sell some of it at a profit. I usually recommend people scale in and out of positions, so that doesn't mean if it gets to a nice price you sell the whole thing. It means you may be willing to sell some of it. On the other hand, if you like this stock and you have held it for a while, you also might be willing to pick up additional shares if the stock got down to a level of maybe technical support is a good example. You might be willing to pick up a little bit more because, again, if your long-term outlook is positive, then that may make sense for you. So if you could imagine a strategy where you could specify the exact price at which you'd be willing to buy a little bit more of this stock that you already like, and at the same time specify a price at which you'd be willing to sell some shares to take some profits, and then you could use a strategy that would allow you to get paid for basically defining those two price levels. That's really what a covered combination does. You could use limit orders. A lot of people, in fact, most people, I think, when they find a stock that they want to buy or if they want to buy additional shares, they'll set a limit price somewhere below the current market so that if the stock does dip on a weekday or whatever, they can pick it up cheap, and at the same time they might set a limit order to sell it if it gets to a certain point. Well, this essentially accomplishes the same thing, but the nice thing is instead of getting nothing when you enter those orders, you're going to get paid on both ends while you just basically sit and wait.
Well, let's talk about exactly how, our investors would implement that strategy. Some I'm sure some of our listeners know how, but, I think there are probably maybe more who aren't sure. So in order to, how about if we use XYZ as our underlying? And,
sure.
How about if we go about, explaining that?
Perfect. So let's pretend, say, for example, you own, let's just say 400 shares of XYZ. This is a stock you've held for a while. How you acquired
my favorite stock.
Yeah,
by far my favorite stock.
Yeah. So how you originally acquired it is irrelevant. Maybe you bought it. Maybe you sold a put and got assigned. Maybe who knows? What's the important point is you own it, you like it, you don't really have a whole lot of intentions of selling it unless you can get a really favorable price for it. But at the same time, maybe in reality, your goal would be that you'd like to own 5, 6, 7, or 800 shares, or even 1,000 at some point, but only if you can pick it up along the way at really favorable prices. So you take a look at a chart, and this is, I think, a point where technical analysis comes in very handy. You look at a chart and say you look at a 12-month chart, you can fairly easily, even if you don't know a lot about technical analysis, you can fairly easily draw a line of support where it goes across all of the lowest points that this stock has reached, say, over the past 12 months. And at the same time, you could easily draw a line of resistance, which would connect the peaks each time the stock got to its high before it came back down. So let's say you identify 2 points and you say, okay, this stock, which is currently at $100 a share, if I look back over 12 months, I can see that there were about 3 or 4 times where it got up very close to about 110, but then it came back down eventually. And at the same time, if I look at the bottom side, I can say, well, hey, I can see several times where this stock came down and bounced off a support around, say, 87.50 would be a good example. So what I would do is I would enter an order to sell a covered call out at 110, which means that 110 is a price at which I'd be willing to let 100 shares go. In other words, if it gets back to its year high, I'd be comfortable with selling off 100 shares and taking some profits because it's been there a few times and I can see it typically has trouble creeping beyond that. Let's just say, let's use 2 contracts. Let's say I'd be willing to let half my position go. So I would enter an order to sell 2 covered calls at a strike price of 110. But at the same time, I can also look back over the last 12 months and say that, hey, a couple of times this thing came down to that 87.50 level, but it never really broke below that. That would be a good price to think about maybe picking up some additional shares. So at the same time that I sell those 2 covered calls at $1 at 110, I'm going to sell a couple of puts at 87.50. So what this does is it says if it gets to 110, I'll sell off half my position. If it gets to 87.50, I'll add another 200 to my position. So that's the covered combo. You can enter that as a single trade, which is sell 2 calls at 110 to open and sell 2 puts at 87.50 to open. The neat thing about it is you bring in money on both of those trades because they're both opening trades, and whatever the price of those 2 options combined is the amount of cash that you would generate at the moment when you enter the trade.
And how about the risk in that position? By the way, that was a great explanation of how to pick strike prices, but talk to me about the risk.
Sure. I mean, there's obviously risk in this trade. There's no investing anywhere of any kind using options or otherwise that have no risk. But this one I like a lot because the risk is fairly easy to understand, to identify, and it's actually fairly far away from where the stock is at the moment. I think most people that are familiar with a covered call understand that if you sell a covered call, say, for $1, you give yourself a little bit of downside cushion by $1. If the stock drops more than $1, you've got some risk. The neat thing about this one is that you get downside protection not only in the amount that you bring in on the covered call, but in addition to that, you also get it in the amount that you bring in on the sale of the short put. So if you, say, sold the covered call at $2.50 and you sold the put at $2, you'd have $4.50 of downside protection before you end up with any risk. So the interesting thing about this strategy is that it's got, in my opinion, the widest range of outcomes over which the trader would be happy or would be comfortable. Generally, a strategy is either it's bullish or it's bearish or it's neutral or it's breakout, but the stock has to move a pretty fair amount. In this case, you've got a pretty wide range. If the stock goes nowhere, you haven't lost anything, but you've gained all the option premium that you received on both sides. If the stock runs up, you end up selling half your position off at the 110, but your effective profit's going to be much greater than just that $10 move in the stock, because it's going to be the $10 move plus the premium of both options, which is nice. If the stock goes down, as I mentioned, it has to go down all the way to 87.50 before you get assigned, and then you'll end up paying 87.50, but your effective price, again, on those 200 shares is going to be even less than that 87.50. It's going to be the 87.50, and then you can subtract from that all of the premiums on both options again, and your effective price is going to be way down, maybe around 82 or 83, which means that effectively you just picked it up below its 12-month low. And that doesn't mean there's no risk. Again, if the stock drops all the way to 60, sure, you've got risk there, because even an effective price of 82 doesn't help you when the stock's gone to 60. But what's neat about it, though, is that if this was a core position of yours, a hold position that you intended to hang on to, you're still way better off, even if the stock does go off a cliff, than what you would have been if you hadn't done anything. You'd be better off by all of those option premiums that you brought in.
Boy, I like the way you explain these things. The break-even points, above the strike price you've sold and then below the strike price you've sold on the put side, really crystal clear. So just to emphasize, there's a wide range of positive results for the investor in this strategy.
That's right. In this strategy, as the trader, you can be comfortable with the stock going mostly sideways, with the stock going up a little bit, or the stock going down a little bit. Even if the stock goes up a lot, you should be okay with it, because ultimately what ends up happening then is you sell off 200 shares at a pretty decent profit, but you didn't sell your entire position. So even if the stock goes to the moon, the other 200 that you still hung on to, you'd still make a nice profit on those. So that in itself is one of the reasons I recommend scaling out of positions under all circumstances, but in this strategy it works out very, very well. So sharply bullish, moderately bullish, neutral, moderately bearish. It's only in the sharply bearish scenario where the stock just goes off a cliff that you end up losing. But that, again, there's no trade that doesn't have a certain scenario under which it would lose money, but even in that case, the amount you lose is still way less than you would have lost if you just sat on the stock and done nothing.
A couple more things I want to ask you about here. How about, with options, it's always about what month. Any secret sauce to which month to pick?
No, and in fact, I think that's one of the other neat things about this strategy. A lot of times you, like say, for example, when you're just selling a covered call or you're just selling a short put on its own, you're doing it fairly close to expiration. And I would say, to me, fairly close is usually 4 to 6 weeks or less. And that's because these options lose value over time because of time erosion, and you want to be short those options during the time that the time erosion is eroding the fastest. In this particular case, because you're looking at a core holding that you plan to hold for a while, and you're looking at a 12-month chart to pick your support level and your resistance level, I feel like in this strategy you can go way further out. So I would be comfortable, and I have used this strategy many, many times, comfortable going out a month, 2, 3, 4, maybe 6 months even, because in my example here, I've got a stock at 100. I'm giving myself 10 points of upside. If I sell a front month that's $10 out of the money, I'm not going to get a lot of premium for it because it's just too far out of the money. Likewise, if I sell a front month put that's at 87.50, that's a long ways out of the money. There's not a whole lot of premium there. So in this particular case, I would probably be looking at more like a 4, 6, or even 8-month trade, so I can get enough premium and give my stock plenty of time to go in either direction, which, again, is a positive scenario.
And as you go further out in time, do you typically analyze implied volatility levels?
I think implied volatility levels are more important at shorter terms than they are at longer terms. What I usually tell people about looking at volatility is look at volatility in the past for about the same length of time that you're putting on a trade for the future. So if I were to make the decision that I want to sell 6-month options, I would probably look at the last 6 months worth of volatility. That's enough time to have covered, in most cases, probably 2 earnings reports. And we always see these volatility spikes as we approach earnings dates, but it'll give me a good idea of what the likely volatility is probably going to be going forward 6 months by looking at the most recent 6 months. I don't know that it makes a lot of sense to look at volatility 2 years ago if I'm looking out 6 months, and it may not make sense to look at volatility, say, over the last 2 or 3 weeks because it could be tainted by a news report or an earnings report. But if I look at a 6-month time frame, it's going to take all those things into account. And this may be one of those scenarios because it's a little bit longer-term strategy that you, instead of looking at exact volatility, maybe you look at a smooth moving average of the volatility or something like that. But the main thing on this one, most option strategies that involve premium volatility isn't a critical element. You just need to know, and I think most people do know, that when the volatility is higher, the premiums will be a little higher, and when the volatility is lower, the premiums will be a little bit lower on these options when you sell them.
Makes sense. And do the investors typically hold these positions, the covered combo, right to expiration?
This is a strategy that I would typically recommend that, yes, you do that, because that's really the whole goal. The whole goal here is to, at the expiration date, you've got 3 possible outcomes. Either the stock has gone up and you're assigned on those 200 shares at, in this case, a 10-point profit on the stock, plus you've earned a couple option premiums, or the stock has fallen down to the 87.50 level, at which point you pick it up a couple of hundred shares at a really nice price, or the stock ends up somewhere between 87.50 and 110, which in this case, that's a pretty wide range and is the most likely scenario, at which point nothing at all happens and you just have kept a couple of option premiums. So the benefits of these types of strategies that involve short options tend to come mostly towards the end of the time. So if you get out of the positions early, you tend to give up the majority of the gains that you could potentially earn. Now, having said that, there is one scenario where you may want to get out early, and that is if the stock goes off a cliff because of some really bad news event that you completely didn't expect, and then you reassess your belief about that stock and you say, you know what, I don't think there's any chance this stock's going to come back. And in fact, I believe it may continue to go lower. At that point, it may make sense to get out because, as we talked about earlier, the bad scenario is when the stock just goes down, down, down. At this point, getting out early may make sense because while you will take a loss, the loss is likely to be smaller than it would be if you just sat on it. So that's the only time I'd recommend getting out early on this strategy, is if the stock really tanks and you're convinced it's going to continue to go lower after that.
So, possibly our listeners would in advance have at least a mental stop, if you will, at a level where if the stock breaks below a certain point, maybe you just close it down and move on?
Yeah, and in this case, you've got a lot of room. My thought on this one would be if I'm selling an 87.50 put and I'm bringing in, let's just call it $3 or $4 worth of options premiums, I would say at whatever point it gets below that level, so let's say that's 87.50, let's just call it $3 an option premium. If it gets below 84.50 or something like that early on, that's a pretty big drop, and I could get out probably at a relatively small loss at that point that I might want to consider getting out. Because remember, originally you thought 87.50 would be a decent buy price for this stock. If it gets much further than that, to the point where, I guess what I'm saying is if it gets to a point where if it was expiration now, I'd be losing money on this trade, then that's the point where I may want to think about getting out early if it gets there too soon.
Okay. Well, I think we've done a heck of a job covering the covered combination, thanks to your really crystal clear examples and description of how this position works. So I guess right before we wrap, Randy, anything else you'd like to add, either about the covered combo or, investing in general?
No, I would just want to emphasize the point I mentioned earlier. A lot of times people are a little bit intimidated by the variety of different expirations and different strike prices that are available. There are just literally oodles and oodles of combinations that you can come up with when you're trying to pick both a covered call and a short put. So this is one of those scenarios where I would emphasize that technical analysis is extremely useful because you can identify that support line, you can identify that resistance line, and that support line is the perfect place to find the put with a strike price that's the closest to that support level and find a covered call that is closest to that resistance level. I think that's the easiest way to pick strike prices in this scenario.
Well, Randy, can't thank you enough. I think, this is a great interview, and you offered an awful lot. I think this will be one where, as our listeners are out running in the park or doing what they do when they listen to, our show here, they may have to rewind this to take in all that you've offered. So thanks so much for joining us today.
You're very welcome, Joe. It was my pleasure.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Shelly Brown, Senior Vice President, overseeing strategy planning and operations at MIAX Options. Welcome, Shelly.
Good afternoon.
Hey, thanks for taking the time to join us, and let's get right at it. Let's talk to our listeners about what's going on at MIAX Options and exactly what you're doing there.
Sure. Well, we at MIAX Options are enjoying our 15th month of operation. We started in December 2012. We're up to approximately 1,100 classes listed on MIAX.
Fantastic.
Certainly listing the top 1,000 by volume of all multiply listed classes. And I've been very happy with our performance, very happy with the firms that have joined as members, and we're hearing from our customers that they're very happy with the results at MIAX.
So in 15 months, you've made a heck of a lot of progress.
We certainly have. When I met with you last year at the conference, we were about 1% market share. Today, we're hovering around 3.25% market share.
That's fantastic. Let's tell our listeners some of the reasons why this is happening. What sets you apart?
Sure. Well, there are several things. One, at MIAX, when we built the exchange, the whole concept was customer service. We built a platform from scratch, all internal development. We have what we believe to be the fastest trade match engine in the country, perhaps in the world, for an options exchange. We have been extremely reliable. We've had 100% uptime since we went live in December 2012. We've had no obvious errors as a result from system outages. We've had no self-helps called against us by any of the exchanges. And our customers, again, have experienced extremely good service, extremely good speed, and they seem to be very happy with their trading results at MIAX.
It sounds like you are really getting the job done over the first 15 months.
Well, thank you. And we believe we are. We have a very experienced team. Several of us came over from another exchange where we had worked together. We've built several different exchange platforms together. We had a chance to build something from scratch. And the overall design of how the systems work was all proprietary and all built for today's options traders.
Well, today's options traders, that's a very varied group. Most of our listeners tend to be the retail client. Of course, we've got the professional, institutional types. And, over the last number of years, volume in the industry has been growing by leaps and bounds. And I think a good part of that is due to the innovations of, exchanges like MIAX Options and the different benefits that they bring to the retail and institutional customer.
I agree. And it all starts with the retail customer. So we looked at the marketplace and what can we do to help the retail customer? What can we do to help liquidity providers that provide liquidity to the retail customers? So
good questions. Let's go through that.
Certainly. From the perspective of the liquidity providers, those that are providing liquidity for the retail firms, they need several things to be comfortable making tight, liquid, and deep markets. Those things include speed. They need to be able to get their quotes in and out of the markets very quickly. For example, a quoter who's quoting an option like Spiders, which has over 5,000 individual products. Each of those market makers are required to have two-sided quotes in all 5,000 plus options in Spiders. It takes time to get those quotes in and out of the market. There's risk involved in every one of those quotes. They're not quoting just the individual Spider equity at this point. They're quoting all the options that are at risk in all those options. So to build a system that provides them the speed to be able to get in and out of the market and change their quotes efficiently allows them to make tighter quotes and more liquid quotes for the investor.
So do you think those technologies that you're building are more efficient than back in the old days when I would scream, change that quote from 5 1/4 to 5 3/8, and it's a little more efficient now for the investor?
You actually just showed how young you really are, 5 1/4 to 5 3/8.
Exactly.
I remember when they were 5 to 5 1/2. The quotes definitely are much tighter today, and it's one of the reasons why the technology is so important. When you have products like Spiders where the front month options are trading a penny or 2 pennies wide, there's a tremendous amount of risk there taken by the liquidity providers. They're interested in taking that risk. That's their job. But they need to know that that risk is controlled, that if there is a significant change in market conditions, that they can move their quotes. And that's where the speed comes in. The speed isn't about trying to race anybody to a price. It's not about the high-speed races we've heard about in the press lately on the equity side of the business. This is very different. This is speed allowing the market makers to provide the liquidity they want to provide to the retail customer. The retail customer benefits by having tighter markets and having more liquid markets and having more certainty in price.
And indeed, they do. And, I give a lot of presentations, at various events, and I try to inform retail investors what a fantastic environment it is for them in the listed options market. I mean, so many retail investors are spoiled. You hit the button and, you get your report back and it's a couple seconds and away you go. I mean, that is, that's nirvana.
It is nirvana. I would say if it's a couple seconds, you need to change brokers. Things are happening so much faster now than they used to. But the reality is, for the retail customer, the options market today is far superior than it's ever been in the past. There are so many more products traded, whether it be the lesser volume, lower volume equities. Those markets are tighter than they've ever been. But the high volume stocks, those top 10 or 20 stocks, the markets in the options are as tight or tighter as they are in the equities. And because there's so many different options to choose from. The cost of execution is down lower than it's ever been. The retail experience in terms of being able to get price improvement in the market, being able to see what you see is what you get. They've never had the opportunity in the past like they do today to trade these markets.
You're exactly right. And speaking to, some of the additional benefits and the innovations that MIAX Options will be coming up with, talk a little bit about some of the developments going forward from a technology standpoint.
Certainly. If I may, I'd like to look back a little bit and then talk about what we're doing going forward.
Sure.
It is in MIAX Options' DNA to provide a secure marketplace, a fair marketplace, have all participants have equal access to the marketplace. We built protections in day one, things such as our one-tick price collar, where orders are always protected at the NBBO or one tick through the NBBO if it's an order that oversizes the marketplace.
And just a NBBO, for our listeners who may not be familiar with that, what does that represent?
Certainly. That's the national best bid and best offer, the best price available in the marketplace from all the exchanges. We do have 12 exchanges. These 12 exchanges are all competing with each other on both price and speed. The retail customer, when they enter the order through their broker has a choice of where to send their orders. The choice is often dependent upon certainly the first thing is where do I get the best price for my customer? Best execution is always paramount. And all of the brokers in the U.S. are tremendous at providing best execution for their customers. But it's the additional questions of where do I have the most certainty of a trade standing? Where, for example, if you have an exchange that may have had an error or had some system problem, while those are very rare in the industry, they are difficult for both the customers and liquidity providers. Nobody wants to have any uncertainty about when they've traded, will that trade stand? As I said, we've had no trade busts on MIAX since we've gone live in December. We've had no bust due to system problems.
And that's December of 2012.
December of 2012.
Yes.
We've had 100% uptime.
And by uptime, I know you referenced that before. What exactly do you mean by uptime?
The exchange has never gone down. We've never had anything that caused us to halt trading in any of the products we've listed on MIAX. And that's, I believe, unprecedented for a brand new exchange.
Fantastic.
We're very proud of that.
Well, and anything else before we speak to going forward?
Sure. The price protections are very important. The customer service is very important. We have a very experienced customer service team. We have folks on our team that were very senior in customer service and other exchanges before coming to MIAX. The entire staff in the customer service desk has former options trading experience. We understand the business. We understand the problem. So if a customer has a question or a problem with a fill or a trade or perhaps missing a trade and they call their broker and their broker calls MIAX, they know they're going to get a reasonable answer. They know they're going to get an answer that deals with what happened in the marketplace, the tools we have in place to talk about whether a market moved in advance of an order coming in or what caused what may appear to be an errant trade or may appear to be missing a trade. We have all the technology readily available in a customer service perspective to service the retail brokers so they can service their customers. So it all goes back again to that certainty of why something happened and if it happened, was it fair?
Fantastic. Customer service is critically important.
It really is. Then recently being the last 12 months, the SEC has asked the exchanges to work on improving their price protections, improving trade protections, improving obvious error rules, basically trying to improve the customer experience. A lot of the things the Commission has suggested the exchanges take on going forward as far as improvements in those protections, MIAX already had in place. And we're constantly adding additional protections, things like auto cancel and disconnect. If a firm loses their connection to the exchange, they can have the orders automatically canceled so they can re-enter them in another exchange. The pricing protections, the collars we have in place. We've had some firms come to us and actually said our protections are too tight for the customers. So we recently had approved by the SEC what we're calling our multi-tick protection, where a broker can specify how much protection he wants for his customer. Again, these sorts of things set us aside from our competitors.
And they are details, as you suggest, that are just enhancing the trade experience for retail and professionals alike.
Absolutely. And again, it's all about providing the best price, but also providing certainty.
Nothing more important.
Correct.
Okay, well, maybe before we wrap, some of the initiatives you may be talking about bringing to the table in the next 6 to 12 months.
Certainly. Well, the multi-tick functionality I just mentioned was approved by the Commission last month, and the software is being rolled out over the next 2 weeks. Will be turned on mid-May. The next project we have, which again was just approved by the SEC, is what we're calling MIAX Prime. That's the price improvement mechanism on MIAX. It'll allow the retail firms to bring their orders to MIAX, stop the customer at a price, so the customer is guaranteed a no worse than fill. It always has to be at or inside the NBBO, but then it provides an auction and allows other professionals and other customers who may want to take the other side of that trade to provide additional price improvement to the retail customer order.
And that is forthcoming, or you have started to roll that out?
We have not started to roll it out. Development is done.
Mm-hmm.
We expect to begin the rollout in late May, turn it on in mid-June.
Okay, right around the corner.
Yes, very excited about that functionality.
Very good. Anything else from the MIAX option standpoint? Because then I want to just ask you a little bit about the industry at large.
Sure. The next major project we're working on is complex orders. It allows customers, if they want to trade spreads, whether they're rolling a position from one strike to another or rolling a position out over time from 1 month to another, if they want to do option versus stock trades, any combination of options, we're going to then support what we call complex orders or spreads.
Sure. And when you talk about the complex order books, you're talking 2 legs, 3 legs? Is there a limit to number of legs?
The initial rollout will be options only, not options with stock.
Okay.
Options with stock will follow shortly behind. The way we're currently building the system will allow us to do up to 8 legs of options.
Yep. Who the heck wants to do an 8-legged trade? But that's another story.
That's a whole other story. The reality is in day one, we're probably going to roll it limited to 2 legs very quickly, ramping it up to 4 legs. So if a customer wants to do an iron butterfly or a condor or a box, I don't know how many customers do boxes, but give the customer the ultimate flexibility. We understand the majority of complex trades are one option to another option, so just 2 legs. We'll certainly support that in day one. We have some other ideas that we're not ready to unwrap yet, but again, it's all about the customer experience. And the nice thing about this complex order book is it works at the same speed as our regular MIAX options platform. And again, we believe we have the fastest matching engine on the street.
Well, you've come a long way since December. Was it December 7th, 2012?
December 7th, 2012.
Come a long way quickly, so good for you. As I said, before we wrap, let's go to the big picture, industry-wise. Our focus here is kind of the retail listener, the retail customer. Do you see obstacles? Do you see potential good things coming down the road, from a broad perspective as it relates to the listed options industry?
Well, I think one thing you're going to see going forward is all the exchanges are going to increase their speed. It's a competitive issue. That's a good thing for the customer. It's a good thing for the market maker. It's a good thing for the industry. Speed in and of itself is not a bad thing. The other thing I think you're going to see, one of the things that we do on MIAX is the fairness of access to our market data. Everybody has access to all of our data feeds. All the data feeds receive the same data at the same time. Most of our competitors strive to do the same thing. I think that'll just continue to improve over time. All the market data will be faster. Everybody will get faster information. The thing the retail customer has to keep in mind, though, is the retail customer is making decision at what we call mouse speed. They're not trading algorithmically.
And that's mouse speed, huh?
Mouse speed.
Yes.
How fast can you look at the screen, make a decision to buy or sell an option or a spread, and then press the button, press the key, pick the option you want, and press the key to send the order. So there's your mouse speed. So speed at some level is less relevant for the retail customer. But where it is relevant is speed of market data. The customer wants to know that the markets he's seeing on the screen are accurate. And again, ourselves as well as all the exchanges have increased their speed of their market data feeds. Everybody wins to that.
Indeed they do. Well, Shelly, I really appreciate you taking time to join us again this year. Tremendous growth over the last 12 months, and we look forward to doing this again maybe 12 months down the road with more good stories to talk about.
I look forward to that as well.
Thanks very much, Shelly.
Thank you. Have a great day.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, I'd like to start with a tool I've mentioned before and one all serious option users should use. That's the OIC historic and implied volatility charts. These important charts are found on our website, optionseducation.org, on the Tools and Resources drop-down bar. 3 links down on the left, you'll find historical and implied volatility. Click that link, and up comes recent historic and implied volatility data in tabular form. On the right side of this page, you'll find 4 thumbnail charts. The first is the price chart of the underlying. The next smaller chart is the volume for that underlying. The third thumbnail chart, the really important one to me, is the volatility chart. This chart shows the 1-year history of the 30-day historic and implied volatilities. And as a reminder, historic volatility is how much the underlying has moved in the past, a black and white statistic. Implied volatility is the market's forecast for how much the underlying is expected to move in the future. So there is a predictive element to implied volatility. Now, for you listeners who are pretty well versed in options, you know how important vol levels are for option pricing purposes. The higher the implied volatility, the higher the option premiums. Now, the fourth thumbnail chart on the right side is the daily options volume. So please do visit our site and get comfortable with these charts if you haven't already. And by the way, you'll find lots of other great tools on the Tools and Resources dropdown at the OIC's website, optionseducation.org. There's a virtual trading system, a position simulator, various calculators, actually over a dozen tools in all. Again, that's the Tools and Resources drop-down bar at optionseducation.org. Now, for you listeners who are looking to advance your option knowledge with the support of an industry expert, I'd suggest you Google the phrase options mentoring services or option mentoring. Below the ads, on this page, you'll find a number of websites that introduce you to really qualified experts who specialized in options education. And lastly, in today's segment of Tools, Resources, and Good Reads, it's with great pride I'd like to suggest today's good read, and that is Trading Stocks and Options My Way by Skip Raschke. Skip and I, we go way, way back. Ex-floor traders on the Philex. We met all the way back in 1981. Skip just released this online read. It's a book full of insights, how the markets work, explains what to look for, and also offers how Skip uses his tools of choice to assess markets and to set up different option trades. Try not to miss this one by Skip Raschke, Trading Stock and Options My Way. Well, that's it for today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back segment, we'll take a quick look at the summer of 2011 and focus on the markets in August of that year. That's the month the U.S. lost its AAA credit rating. Now, the listed options industry had a crazy busy month, as you'd expect. We traded over 500 million contracts that month alone, as many contracts as we traded in all of 1999. The industry also recorded its 4 highest volume days that month. Our busiest day on record was August 8th, 2011, when 41.5 million contracts traded. Now, over the past couple years, we've been averaging somewhere in the neighborhood of 16 to 17 million contracts a day, so 41.5 million on August 8th, 2011 was quite a milestone. As you'd expect, the market sold off quickly from just below 13,000 in the Dow to just under 11,000 before bottoming at just below 11,000 in early fall 2011. With just a brief few pullbacks since, the market's been on a tear. That summer, the NASDAQ pulled back from about 2,800 to 2,300 and has been on the same bull run since, as has the S&P 500. Now, our VIX levels in the spring, early summer of 2011 were in the maybe not too much happening range of 15-20. Now, the VIX did spike to the mid-40s briefly on the news, but by the following spring, we were again back to the 15 range in VIX. So remember, generally speaking, when the VIX rises, option premiums increase, so buyers pay more to own the rights associated with long option positions, and sellers demand higher prices because of increased movement and volatility in the markets. That's our looking back at the markets for August 2011. And it's another example of the old market adage, buy on bad news, sell on good. Thanks for joining us on today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_EDU. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.